Hi friends, I'm Rebecca. Welcome to Squintillions. We are in a 10-year-long bull market, and for the last few months, we've watched as many companies hit new 52-week highs, but last week saw a dip in stock market prices. According to MarketWatch, the Dow Jones Industrial Average fell 12.4%, the S&P 500 lost 11.5%, and the NASDAQ was down 10.5%. Some gains were made on Monday, March 3rd, and then Tuesday, we had the Federal Reserve announce an interest rate cut of a 0.5 percentage point, which led to further action in the market. I wanted to share what I was doing last week as prices were dropping. This was all according to my plans, and what I'm going to go over now is not financial advice for you. We continue to face volatility in the market as various news events unfold across the world. You should take into consideration your personal situation, risk tolerance, and financial goals, as well as completing your own research before making any investments. Before we get into what actions I took, I wanted to share something that I heard on the Afford Anything podcast by Paula Pant. She was interviewing David Stein, the former Chief Investment Strategist and Chief Portfolio Strategist at Fund Evaluation Group. He wrote a book titled Money for the Rest of Us, and the podcast covered 10 questions to master successful investing. I'm not actually going to go into any of those 10 questions, but I wanted to highlight a statement he made in the middle of the interview that I found really freeing when it comes to investing. He said, "There is no such thing as a perfect portfolio." It was such a simple statement, but felt profound to me. It gave me permission to reduce my anxiety about my investing choices. It allowed me to feel comfortable knowing that I'm not going to be able to chase down the very best price on an investment, that I'm not going to be able to optimally invest every dollar. I know my portfolio isn't even perfect for me now, as I'm trying to fix some of the issues I have with it after I had investments made that I wouldn't have necessarily chosen myself on the advice of a financial advisor who I no longer use. I am slowly working to rectify those investments. But even once I have done that, by nature, my portfolio just isn't going to be perfect. And knowing that relieves some of the pressure to try to make it that way. I hope sharing this idea will help some of you too. Now, reflecting on the past week, most of the action took place in my IRA at TD Ameritrade. There were a few reasons that I had some cash in this account. I had deposited my allotted $6,000 contribution for 2020 into the account, but hadn't yet invested it. I had also built up some cash over the year from some dividends that I decided to not have automatically reinvested, mostly from companies that I don't plan to keep for the long term. At the beginning of January, I had also sold some shares that I had in Facebook, ticker FB. This was one of those investments bought when I had an advisor. I didn't want to remain invested in the company for a few different reasons, which I won't go into here. I had decided to sell my 64 shares after the share price went over $210. Once that happened, I set up a few different limit orders in my IRA to redistribute the money to dividend ETFs that I wanted to buy. I was anticipating that there might be a slight dip in the market at some point in February, following the enthusiasm we were seeing in the market in December and January, and having heard of the January effect. I set up my limit orders to be just a few dollars below the prices that the ETFs I wanted to invest in were trading at. Then, on Monday, February 24th, my first limit order went through for the FlexShares International Quality Dividend Index Fund, ticker IQDF, at the price of $22.87 per share. On Wednesday, a few more limit orders went through in that account, including for my favorite ETF, which is the Spider Portfolio S&P 500 High Dividend ETF, ticker SPYD. I bought SPYD in 2 batches one at $36.60, and one at $36.20 per share. I also added to my position in the Spider Russell 1000 Yield Focus ETF, ticker ONEY, at $68.30 per share. I opened a new position in my IRA in the iShares Core High Dividend ETF, ticker HDV, at $90.15. And as I watched the price drop lower that day, I set up another limit order on it, which ended up being filled on Friday for $82.40 per share. On Thursday, I added to my positions in 3 more ETFs. These were the Legg Mason International Low Volatility High Dividend ETF, ticker LVHI, which I bought at $25.61 per share. The Schwab US Large Cap Value ETF, ticker SCHV, that I got at $55.22 per share. And the Vanguard High Dividend Yield ETF, ticker VYM, at $86.10 per share. I have been wanting to add more shares of the Fidelity MSCI Real Estate Index ETF, ticker FEL, to my portfolio, but the price was up higher than I wanted to pay for many months. My limit order was finally triggered on Friday, and I was able to buy in at $26.21 per share. With the last of my cash in my account, I decided to buy more IQDF since it was now even lower than I had bought it for on Monday. I chose to add more into this particular ETF because I don't have a lot of international investments in my IRA, and this one's dividend yield was up at 5%. I bought it at $21.41 per share. I invested all of the cash that was sitting in the account. I figured it was better to get it all going to work for me now and not to worry about what I was going to do with it in the future. Do I feel bad about not getting the lowest prices on these purchases? A little. But most of these ETFs I managed to buy in the middle of the range of what they had cost the week before and the lowest that they hit last week. Given that these investments are in my IRA and I won't even be accessing this money for another 20 years, I'm okay with this. And I'm just glad I didn't pay for these ETFs at their highest prices. Meanwhile, I'm looking forward to earning dividends in the next few months that will be automatically reinvested, hopefully in a lower price range. After all of these purchases, today the overall value of my IRA is down just 1%. Its value is being held up by large investments I have in Comcast, ticker CMCSA, with an overall gain of 28%, since my initial investment, and AT&T, ticker T, with a gain of 24%. Also, I have a smaller position in the Schwab US Large Cap Growth ETF, ticker SCHG, which is showing a gain of 39%. I do have other investments in this portfolio, but I'm keeping some of that information private. I just wanted to share my actions during the market dip. You might be wondering how my dividend-focused TD Ameritrade Trust account is doing that I've talked about a lot on this channel. Last week, I added to my positions in HDV and the Walt Disney Company, ticker DIS. I picked up both of these on Wednesday and ultimately not at the lowest prices, but I added just 5 shares of HDV at $90.25 and 10 shares of Disney at $126.70. I had noticed the price starting to come down for Disney because I had already set a limit order to add 10 shares of Disney to the custodial account for my oldest son. That order went through at $128.20 on Tuesday. The price kept dropping with the rest of the market, as well as the news that Disney's CEO Bob Iger was stepping down from that position and assuming the role of executive chairman in order to direct the creative side of the business. Bob Chapek was named as the CEO. I believe this announcement led to a greater drop in Disney's share price than what might have otherwise occurred. I later added another limit order to my son's account for 5 more shares of Disney, which went through at the price of $118.20. I also added more SPYD into his account, buying in 2 batches at the prices of $36.25 and $34.70. I ordered the same prices on SPYD for my younger son's account. But he wins the race to the bottom on the Disney shares, as I was able to add 10 shares into his account at the price of $114.82. Both of my sons had some money in their accounts waiting for investment because they each had a handful of Facebook shares that I had sold off to. I didn't have as much money to work with in my personal E-Trade brokerage account as I did in my IRA, but during the past week I did add a few shares to some of my positions when I saw the prices dropping below my original purchase prices. These were the Global X Super Dividend US ETF, ticker DIV, which I bought at $21.52. The iShares Core S&P Small Cap ETF, ticker IJR, bought at $75.20. The Vanguard International High Dividend Yield ETF, ticker VYMI, bought at $57.92, and the Vanguard FTSE Developed Markets ETF, ticker VEA, at a price of $39.95 per share. I only added one individual company in this account, Pfizer, ticker PFE, buying those shares at $34.20. I have many different investments in this account, which I'm also keeping private. I still have $2,000 cash in E-Trade that I haven't allocated to anything. Let me know in the comments how you would invest it. I also added a few shares in my new Webull account, but I'm not going to go through those in this video, as I am planning on making a separate video introducing my Webull account soon. If you enjoyed this video, remember to hit the like button and subscribe for more content on personal finance and personal growth here on Squintillions. Thanks for watching.